But this only matters if you have a product with guarantees, and IULs don't have any guarantees. It's all based on the performance. And even if the company doesn't fail, the company may not fail, but because you have an IUL, they're gonna use your policy as a profit center to take care of the products that they have guarantees behind, right? Annuities, whole life insurance, term policies that they have to pay out, anything else that they have guarantees behind. And if they're short on cash, they're gonna reduce your cap rates, they're gonna increase your charges, they're gonna create another profit center out of your Index Universal Life to actually be successful. Hey everybody, it's Chris with Life 180, long time no talk. So I just felt compelled to continue my book review of Doug Andrews' book, The Laser Fund. Go through, continue the conversation, talk about the good, the bad, the ugly of this book, give clarity around life insurance as an asset. He talks a lot about life insurance being an investment alternative. And so I'm going to get into that and go through this chapter, which is actually a really important chapter in the book called Laser Focused. And so the Laser Focused chapter is going to go through kind of where the term laser fund comes from. It's going to give you some of the foundational understandings and the nuances about how these policies work and how you can leverage them. So here we go, let's get into this. So, you know, we hear the term laser focused, he says, but what does that mean? So going through this, just to kind of summarize, LSR is liquidity, safety, and rate of return. That is kind of where laser comes from. If you put those together and it is what it is. So income during retirement, because he says, obviously, the whole purpose of this laser fund is to help get you closer to your goals, which may be income in retirement, money to empower your family's legacy, and bank and loved ones' worthwhile efforts, capital investments, or other objectives, right? So like this is what he's saying that the purpose of these funds are. They're kind of like all-inclusive, help handle all of these needs for you, whether it's retirement income, family legacy stuff, and he's going to get into it more as we go here. So liquidity, let's get into this. There's some things I found here that to me should be tightened up. If I were him, I would tighten this messaging up a little bit, but he talks about liquidity. So let's start with the liquidity conversation. Liquidity is the ability to access your money when you need it. So if you try, and then down below in the blue here, I underlined it, it says, if you try to pull your money out correctly, you can access your money income tax free. All that is true. Fantastic. There are 3 ways that you can pull it out: the sad way, the dumb way, and the smart way. I got to give him credit. That's fun. I like the way he's doing it. The sad way is obviously it's life insurance. So if you die, that's a sad situation. You don't want to do that. Now he goes on as a side note here. He says, compare that money that you might have in an IRA to a 401k. When you pass away, the money in your 401k will go to your beneficiary, but it's also going to carry with it tax liabilities. And that is absolutely true. So you want to make sure that you understand all that. But here's the problem. Anytime you're comparing life insurance as an investment to a traditional investment vehicle like a 401k or an IRA or a Roth IRA or anything like that, as an advisor, if you're somebody who's following Doug's teaching as an advisor, it's a really, really dangerous track to walk down, regulatorily speaking. Do I believe some of it foundationally? I would say yes. I definitely do, I guess, that I believe in leveraging life insurance as an asset. I don't believe in doing it the way he says to in an Index Universal Life, and I'll explain why as I go through here. So he explains some of the stuff. I'm not going to get into the details of kind of all that because I'll get into it more later. He talks about there are a few dumb ways that you can access your laser fund. The first one would be to surrender the policy. Because it would trigger taxes on any gains that your policy has earned. So the key thing to there, it would trigger. So I think, remember, that's on gains above and beyond cost basis. So I would say that could trigger taxes. If you surrender during the surrender period, which is typically the first 10 years or so of an IUL, typically speaking, the amount of premium that you've put in because of the surrender charges, you're not going to be able to pull as much out as you've actually contributed to the policy. So the likelihood of there being gains that you're going to have to pay taxes on if you surrender are unlikely. Also, if you were thinking of 1035 exchanging the money into a different type of policy, that is also an option. So, and there are no tax consequences from like product to like product. You could kind of take that into consideration. So But you know, this brings up a point of the surrender period. One of the big reasons that I love whole life insurance is because I work a lot with real estate investors and business owners. Now, with real estate investors and business owners, it's, you know, it's a different philosophy, because it seems to me, I've never spoken to Doug personally, but it seems to me he focuses a lot on retirement income. And the reason I find this conversation so dangerous is because when you talk about retirement income and index universal life, and you look at all the moving parts inside of IULs, you're talking about a long-term game. And the fact is, I've got playlists on this that show how insurance companies are designed to reduce cap rates on all these products, and they're never going to perform long-term as they show on the illustration. So I'm a big believer you can deal with anything you expect, but the problem is these are sold in such a kind of safe upside potential, downside protection sort of way. People, when they don't actually achieve the results that are illustrated, they're not prepared for that, right? So that actually has a negative consequence in their life, and that's a big problem that I have with it. Now, on the flip side, for the way that I work with people, you know, I'm all about real estate investing. I'm all about building your business. Now, when you structure a policy properly with a whole life policy, it's much more liquid in the first 10 years, and being able to leverage that. So I look at it as an asset. Like, I don't think you should ever put your money into a life insurance policy to invest. However, if you look at it as a savings alternative, a banking alternative, and then being able to have that money grow and beat inflation, right? So it's safe, it's protected, it's guaranteed, then you can borrow against that money and leverage it to get the investment in your real estate, in your business, in whatever it is you choose to do, whether it's crypto or anything else. You can make the returns outside, but that's why my buddy Caleb calls it the and asset, right? Like, because you can create this ecosystem where the returns actually exist outside of the policy, but it is the actual policy structure that allows you to have this ecosystem to show up more powerfully in your life, right? Because it's this self-completing vehicle. I always say life insurance, a properly structured whole life policy, is the only thing that will make sure that what you want to happen will happen when you want it to happen, whether or not you're here to see it, right? So that is that. So okay, get back to this here. If you surrender the policy within the first 10 years, okay, that's another dumb way would be to withdraw more money than you've put in. So that would withdraw more money than you put in the first 5 to 7 years during funding your policy. That is true. That's going to create all sorts of problems, not tax problems, but it's going to make your policy implode. So then he gets down, or it's going to likely cause your policy to implode. I don't want to make blanket statements and say anything is absolute, so because it's not. The smart way to get money from your policy is by taking a loan from your policy. I agree. And I got to give him credit for saying you never want to pull out more than 80 to 90% of your cash value, especially in an IUL, because of the way they're structured, the fact that there's, the market could drop out, and even though, and I think he talks about this later in the chapter, but even though they always say there's downside protection, remember, when you are 60 years old, typically when people are going to be tapping into the money in these policies, 60 years old and up, your cost of insurance is getting more and more expensive, because the way that the insurance charges inside of these policies work is it's basically like an annual renewable term, right? And so every year the cost of insurance is increased. Now, it's supposed to be offset by the fact that the net amount at risk for the life insurance company, because your cash value is going up and your death benefit is level, so the net amount at risk is going down, so that's supposed to offset. But when you have a negative performing year, you have those high charges, you have no upside, and if you use an indexed loan, which he says is his favorite style of loan, that means you have negative arbitrage, meaning if you have a 5% loan and the policy performed at 0, that means you have negative 5% arbitrage that year, plus the insurance charges. And so when he says there's downside protection, depending on the loan style that you use, if you use his favorite style of indexing loan, that creates negative arbitrage. And if you do that when you're in your 60s or even 70s, if you're using this for retirement income, and you have a couple years, 2-3 years like that in a row, your whole financial plan utilizing these vehicles can just go up in smoke. And it really is incredibly horrible to see the catastrophes that I've seen that kind of come from this. So loans can be dangerous if you have, Yeah, so I wrote loans can be dangerous even if you have 80 to 90% borrowed because of the facts that I just told you. If you have a couple negative years, that can be really, really bad. So laser fund loans. So this is where he goes through what I was just talking. You have a wash loan, a zero wash loan, and the index loan. Right here, it shows I have the star with the index loans boxed out there. You can borrow, let's say you can borrow at a guaranteed rate of 5%. It's basically saying that you're participating in an index. The index, the loan rate can fluctuate based on the market environment, but it allows you to build in arbitrage, right? Like, so if the market, let's say you have a cap rate of 8%, you can have positive arbitrage built in. If you're paying 5% and you earn 8%, well, that's positive 3%. But there's also risk associated with that. And so one of the ways that I love to do that with whole life is that you can build in positive arbitrage as well, but you have to use cash value lines of credit, right? And by using cash value lines of credit, the cool part about doing that is you can build in a positive arbitrage on a guaranteed basis, whereas this index loan is not guaranteed by any stretch of the imagination, right? So you actually leave yourself susceptible in doing that. You can also do wash loans, but that just doesn't illustrate as sexy, right? So they typically don't show it, because the crazy part on illustrations is every time they illustrate it, they bake in, typically most illustration softwares bake in about 50 basis points or a half percentage point of positive arbitrage. That's what the AG 49 regulatorily allows these software systems to do. And so as a salesperson that wants to make it look as good as possible, these IUL agents always bake that in, even though they don't typically communicate how much risk is actually associated with that. So I think that's important to understand. Let's see. Still following great. Let's look at a quick illustration. Say you have $1 million policy. It's earning 7% a year. It's year 11 of your policy. It'll grow to $1,070,000. Okay, so I said this is a huge flaw. It's deceptive, only looking at the positive side. Okay, so that's exactly what I was just talking about. Sorry, I get a little ahead of myself. I should just follow my notes a little more. So essentially, how you access your money could be the difference between liquidation and liquidity. Withdrawals can trigger partial surrender charges, taxes, and if continued unchecked, could eventually deplete the money in your policy. By contrast, loans provide liquid access to your money throughout the policy life of the policy. So it's all true. You can't qualify. So what he talks about here is another great thing about taking loans on your laser fund is it opens the opportunity to add lump sums into your policy down the road. So this actually works true. It works the same for index universal life and whole life insurance, where if you borrow against your policy, so if you have $1 million inside of your policy, whether it's IUL or whole life, what I call that collateral capacity, because that's your ability to collateralize an asset, right? And so what's happening is you can leverage that money to do whatever you want with it. So if I borrowed $500,000 over a period of time for income or for whatever, so being able to refill that collateral capacity is huge, because you're putting that money into a tax favorable environment, right? And then from a legacy perspective, rather than that money being tied up, you're able to pass that along to the next generation on a tax favorable basis, which is fantastic, rather than just putting it into a savings account when you inherit it or something else. Now, the crazy part is when you're older, a lot of times health issues come up, costs of insurance are higher, so on and so forth. And so sometimes qualifying for a new policy at that time, even if you can, a lot of times it doesn't make sense. And so, because it's not the most efficient place to store cash. But if you've started this system early, then you can actually use that to recollateralize your account, and it's a beautiful thing. So it's just something to kind of consider there. Let's see, it's been, so he talks about if it's been in place since you were age 60. So here's what I want to say. What I've gathered just in seeing his content, watching him, and getting a sense of what he's talking about here throughout the book, he's talking a lot about utilizing IUL, as I've said, as an investment, right? It seems like he sells these policies a lot to 55 and 60-year-olds as they're getting ready for retirement. To me, I've seen the class action lawsuits and challenges. My guess is because that's his target audience. I get why it's his target audience, because they have more money. But here's the bottom line. if you're 60 years old, you're putting your money into an account that's got surrender charges, surrender schedules on it for the next 10 years of your life. That means you're basically not even going to be ahead of this thing until you're year 10. If you have a real big insurance need, then there can be some strategy to that. But if you're 60 years old, I would really encourage you strongly to think hard about utilizing IUL as an investment vehicle. It is not everything they sell it to be, especially in this book to this point in time. So let's go. Liquidity for life's most important moments. As long as you're out of surrender. That is my note there. So like I've said, liquidity for important moments. If you're using this for retirement income, depending on when you start it, depending on your age, how mature the policy is, it can be very liquid. But at the beginning of the policies, you have big surrender periods. I mean, most policies I look at with IULs, not all, but most, you have almost no liquidity in the first year and very little liquidity because of the surrender schedules for the first 5 years. So for my people that I work with, real estate investors, business owners, this makes no sense at all. It flies, all the actual implementation of IULs flies in the face of all the principles that I teach. And so that to me is a big problem. So let me go to the next one here. $200,000 she put in her account a few months earlier, was still earning the current interest rate of 7%. The 120 loan was being charged 5%. Okay, so he's talking about arbitrage here. So this is simply overinflating a concept to make it look sexy. Okay, so this is just, it's overinflating the concept of building in arbitrage, talking about the upside potential, not talking about the downside potential, because you cannot bake in 2% arbitrage. It doesn't work like that. He's using that example in this book because it looks good and it sells these things like hotcakes, but it doesn't really work like that. See life product review image for, oh yeah, so there's a really good article that I read from Life Product Review. So go ahead and take a second to read this Life Product Review on the quote on how the internal rate of return for index universal lives is not where they say it's going to be. Because what the problem is, Doug says that you can get, let's say we're going to illustrate this at a 7% rate. The problem is after internal fees and costs and everything, and this is Life Product Review is one of the top independent companies that do analysis of all different life insurance products. They break down IUL, they break down whole life, they break down annuities. They're basically industry experts. They're a leading research firm. And the guy who runs it used to be a product developer, I believe, for MetLife. So the guy is a genius, right? And so if you're an agent, I would go to lifeproductreview.com. I don't mind, I get nothing for this. They don't even know I'm making this video, but I love their content so much. It's like $100 a month, but it is to get access to their information. If you're a geek like me and you love that kind of stuff, like I want to keep up on this stuff all the time. So I subscribe to it. It's where I get a lot of my information. I would go there if I were you and check it out. So that's my gift to you, just information that you can go check out. But here's the deal. If you look at what they say a good expected internal rate of return is inside of an IUL policy right now, after all things are said and done, it's 4.57%. I think that's the number. You'll have to look at the quote there just to verify that. But let's say it's just under 5%, right? So if it's under 5% and you're paying this wash loan of 5%, that works. But if you're doing in index, because I think when you do a wash loan, what they're going to do is they're going to make it so you earn 5% guaranteed. You pay 5%, but don't forget there's still going to be charges there, right? Like, so it's not exactly a wash. They have that hedge. The insurance company, remember, insurance companies created this to shift the risk where it is for whole life policies. The risk is 100% on the life insurance company, and in IULs, the risk has been shifted to you, the policyholder, and so that's key to understand. But if you're doing an index loan and you're paying 5%, and your real after all expenses is 4.5%, which is what I say you need to run these things at. And it's interesting when you go to Life Product Review, I just read an article yesterday, and this is the quote that I shared with you. It shows that the internal rate of return that you expect is actually going to be less than the index loan that you're paying. So you got negative arbitrage from a perspective being built in, and that's why these never illustrate the way that they say they're going to. Okay, safety. The biggest lie of IULs I have is the safety concept. because what happens is they sell them based on the AG 49A regulation saying based on the current cap rate, you can illustrate it at a certain amount. Let's say it's 6.5% or 7%. If they're illustrating it at 7% based on the AG 49 rates, that's based on current cap rates, current charges, current schedules, everything in the illustration. But one thing that's 100% certain is that over time, every insurance company is going to drop the cap rates, is going to drop those. It's happened consistently, even in a bull market that we're in right now. Cap rates have dropped, and I have a lot of videos on why that happens. I'm not going to dive into that in this video. Go check out my Index Universal Life training playlist. If you want, I'll tag it up above. You can go check it out. But definitely do your research if you're going to go that direction. But that is a big lie, because when they reduce cap rates, what happens is everything in the illustration blows up. And so that's important to understand. The thing that I don't like here is that he's talking about during the Great Depression, more than 9,000 banks failed. He's talking about the security of life insurance companies, the importance of using high quality insurance companies. And I agree with him because, if you have financially stable insurance companies, they're going to be able to price their products as fairly as possible. And in the world of IUL, it's really important, yes, to have a really good company. Once again, I think the expectations need to be in the 4.5% or so range, because it's going to be impossible for a company's IUL product to outperform their own general fund over the long term. If Index Universal Life, if indexing strategy in general worked so cleanly and so well, and to get these higher returns, remember, all general accounts for life insurance companies are earning right now is like 4 to 4.5%. So if you could get 7.5% using indexing after charges and everything with these policies, then life insurance companies who are masters of risk would be doing this for their own funds. Doesn't that just make sense? So if we just use a little common sense, it goes a long ways at this point in time. So it's about, I don't hate IUL, I hate the assumptions IULs are sold with, because they're just deceptive. So the bottom line, the thing that I can't stand here is that he's talking about 1933, the Great Depression, the Great Recession, all the insurance companies, how they're stable, so on and so forth. But this only matters if you have a product with guarantees, and IULs don't have any guarantees. It's all based on the performance. And even if the company doesn't fail, the company may not fail, but because you have an IUL, they're going to use your policy as a profit center to take care of the products that they have guarantees behind, right? Annuities, whole life insurance, term policies that they have to pay out, anything else that they have guarantees behind. And if they're short on cash, they're going to reduce your cap rates, they're going to increase your charges, they're going to create another profit center out of your Index Universal Life to actually be successful. So that's important to understand. So he goes through these things. They're financially sound with superior ratings. And he's basically ranking tier 1 companies and giving an explanation of what they are. They maintain competitive internal costs, which helps policyholders make the most of their laser fund for living benefits as well as death benefit. They have a good long-term track record in regard to their cost structure. I find it funny that he says that, because he uses Pac Life. I know that he uses Pac Life, and Pac Life has been one of the companies that has been reviewed the most for having the worst cap rates being reduced over time and kind of being deceptive in that marketing. They treat all policyholders well. To me, that wouldn't be well, and that's completely incongruent with what he says. They focus solely on life insurance. They're not involved in auto, casualty, home, or other products. Yes, I agree with that. I would say that the company should be a mutually held company. That's why I believe in whole life policies, because when you own a whole life policy, you're actually kind of like a shareholder of a company, right? The policyholders are the company, and that's where the dividend comes from, kind of like a dividend paying stock. Keep in mind, however, when the markets drop, that it's possible your policy goes down in value. So, he kind of is honest here and says, hey, if you have a negative year, you're protected at zero, but because of costs and charges and all that, he's actually being honest here, saying that your fees could go, that the fees could eat in and reduce your policy value. Man, my notifications keep going crazy. So he's being honest there, but then he downplays it. So this is the thing. He gives this image, and he oversimplifies it. He goes and shows like the power of indexing, but in the power of indexing, like I just did a couple examples showing like he contradicts himself, because he he talks about it above, like your cost could go down, but then he doesn't build that into the equation of truthfully what it would look like in here. So it's not as great in an IUL policy because you have all those charges and fees that go with it. And so you have to take into consideration what those charges impacts are on the policies, right? So the reality is the charges on a 60-year-old person could be really, really expensive and prohibitive. So it's just something that, like, you see my red line there on the graph, like that's really more what it would look like rather than the black line that goes up to 161,000 there. It's more like this, right? So like more like that red line there. And so you got to take that into consideration, you know, and I just don't like that deceptive communication around that. So then he talks about rate of return. Once again, life product review, yeah, it is 4.57%. So look at this graphic here, right? So this just goes to show that 4.57% is the number that you need to be banking on. So while he's talking about 7%, after all internals, fees, charges, all that stuff, 4.57% is really what you're gonna get. So he talks in here about the cap rate being 12.25% on policies for the S&P 500 index. That's actually lower now because of the market and the way everything's gone. Typically between 10 and 11% on those cap rates. You know, and he says you want to have a vehicle that can get you to the desired destination with the most predictability as possible. And my friends, that is whole life insurance. That is not index universal life. It is. So it's just, the contradictions in here is just astounding to me. But talks about the flexibility for the unexpected. Flexibility is nice, but it's often oversold, especially with the surrender periods of these. And sometimes the flexibility isn't always good because people aren't so disciplined, right? So not doing, just being smart, not doing anything amazing, just call options. So he's talking about call options. You know, they're just doing, just plain smart to invest with companies who are amazing at managing risk, right? So my perspective on that is these companies aren't doing anything. I've done videos in my Index Universal Life training list. I have videos in there on how insurance companies actually execute on this indexing concept. They basically are just taking money that they know they're going to earn on a guaranteed basis from your fixed account, from the money that you have in your account. They buy call options with it. Based on the expense of those call options, they can get more or less. That's what impacts the cap rates. And then if you make money on the call option, then you get all that return. And if you lose, that's where the downside protection is, because you just learned the interest they were going to earn on your account on a guaranteed basis. If you want a deeper dive on that, go to my IUL video, and that's it. So the laser fund has historically offered competitive rates averaging 7%. Our clients' laser funds have seen years 12, 16, or even 20%. Can that happen? Yes, there are, with certain strategies, it can. But the rule of thumb is 4.5% to 5% is the rate that I would illustrate an IUL at. If you're comfortable with seeing an IUL, how it performs at 4.5% to 5%, with that assumption, then I would say that's within the realm of expectancy that you should be comfortable with. Can you have bigger years? Absolutely, but then you'll have the negative years to make up for it. The IUL will never outperform the policy or the general fund of the insurance carrier. So here's the thing. If you have any questions about anything, you know, go ahead, comment in the section below, reach out. You can click on a link, set up a time to talk with one of the guys on my team. We have a lot of things that are happening right now. You can see it's been a while since I've created a video. That's because I've been working on a lot of stuff in the background. We're changing a lot of stuff on our end, but we're doing so, and I'm investing a lot of time, a lot of money, a lot of relationships into serving and building tools that are going to be able to help you have more clarity, whether you're an advisor, an agent, or whether you are you know, somebody who is looking to get this product, utilize whole life insurance as an asset in your life, and learn how you can use it to execute in your life. So I hope that makes sense. If you have any questions, once again, comment below. If you haven't already, click that subscribe button, hit the like, make sure you hit the bell. That way you get notified every time I launch a new video. We're gonna get back into the swing of things here. So anyway, I hope you have a blessed, inspirational day, and we'll talk to you soon. Take care.